When you put your hard-earned money into a bank account, it doesn't just sit there in a big vault with your name on it. That's a common misconception. Instead, your money is pooled together with the deposits of millions of other customers. The bank sees this enormous pot of cash not as something to simply guard, but as a tool to generate even more money for itself. They are legally required to keep a small fraction of your deposit on hand just in case you need to make a withdrawal. This is called the reserve requirement, but the rest of it, the vast majority, is immediately put to work. The primary job of a bank, from its own perspective, is to lend money out. Think of it like a giant lending library, but for cash. They take the money you've deposited, your savings, your current account balance, and they lend it to other people and businesses. These borrowers might need a loan to buy a car, start a new business, or purchase a home. The bank acts as the middleman in this whole process. It connects people who have money to spare, the savers, with people who need money right now, the borrowers, and it takes a significant cut for providing this service. It's a continuous cycle of money coming in and money going out. This model is the absolute bedrock of modern banking. Your deposit is essentially a loan you are giving to the bank, for which they pay you a tiny amount of interest, if you're lucky. In return, they get to use your money to make much larger, more profitable loans to others. The bank is leveraging your financial stability and your trust to create its own profits. Without the constant flow of deposits from ordinary people like you and me, the entire system would grind to a halt. It is your money that fuels the engine of the entire banking industry, a fact that is crucial to remember in all your financial dealings. The scale of this operation is truly immense. A large high street bank might hold billions of pounds in customer deposits. This massive pool of capital allows them to make equally massive loans, generating substantial profits day in and day out. They are experts at managing the risk, ensuring that they have enough cash available for daily withdrawals while keeping the maximum amount of money out there earning interest for them. It's a finely tuned balancing act, one that has been perfected over centuries to be incredibly profitable for the banks, all powered by the simple act of you depositing your paycheck. One of the biggest and most profitable ways a bank uses your money is through mortgages. A mortgage is simply a very large, long-term loan used to buy property. For most people, it's the single biggest financial commitment they will ever make. When a bank agrees to lend you, say, £200,000 to buy a house, they aren't just giving you their own money. They are using the pooled deposits from thousands of their other customers to fund your loan. You, the borrower, then agree to pay back that £200,000, plus a hefty amount of interest over a period that can last for 25, 30, or even 40 years. The profit for the bank comes from the interest you pay. Over the long term of a mortgage, the total interest paid can be enormous. For example, on that £200,000 loan, even with a seemingly reasonable interest rate, you could end up paying back well over £300,000 in total. That extra £100,000 is pure profit for the bank. It's their reward for taking on the risk of the loan and for providing the initial capital. The bank secures the loan against your property, which means if you fail to make your payments, they have the legal right to repossess and sell your home to get their money back. This makes mortgages a relatively safe and incredibly lucrative business for banks. They are lending out other people's money to you at a significant markup, and they have a valuable asset, your home, as security. Every month, millions of homeowners across the country make their mortgage payments, sending a steady, predictable stream of profit directly into the bank's coffers. This reliable income allows them to plan, to grow, and to continue lending. It is a powerful cycle that has turned homeownership into one of the key pillars of bank profitability, a machine that churns out money month after month. Furthermore, the bank doesn't just profit from the interest. The long-term relationship created by a mortgage provides countless other opportunities for them to sell you more products. They will likely offer you buildings and contents insurance, life insurance to cover the mortgage, and encourage you to open savings accounts or take out credit cards with them. A mortgage customer is a captive audience for decades, making them incredibly valuable. The initial profit from the loan is just the beginning. The real goal is to make you a lifelong customer for a whole suite of financial products, each with its own profit margin. The secret sauce of bank profits can be boiled down to two simple words: interest spread. This is the difference between the interest rate a bank pays to savers and the interest rate it charges to borrowers. Let's break this down with some very simple numbers. Imagine you deposit £1,000 into a savings account. The bank might offer you an interest rate of 1.5% per year. At the end of the year, they will have paid you £15 for the privilege of using your money. It doesn't sound like much, and it isn't meant to be. It's just enough to encourage you to keep your money with them. Now, the bank takes your £1,000 and lends it to someone else as part of a personal loan or a credit card balance. For this loan, the bank might charge the borrower an interest rate of, say, 7.5% per year. At the end of the year, the borrower will have paid the bank £75 in interest. The bank's profit, the interest rate spread, is the difference between what it charged the borrower and what it paid you. In this case, it's £75 minus your £15, which equals a £60 profit for the bank. They made a 6% return simply by acting as the go-between. This principle is applied across every single product the bank offers, but on a gigantic scale involving billions of pounds. The bank is constantly managing this spread. They want to pay savers the lowest possible rate they can get away with, while charging borrowers the highest possible rate the market will bear. When the Bank of England changes the base rate, all the banks adjust their own rates accordingly, always aiming to protect and maximize that profitable gap in the middle. It's a constant financial calculation designed to extract the maximum value from the flow of money. Even a seemingly small spread can generate huge profits when multiplied by millions of customers and billions in assets. A difference of just a few percentage points across the bank's entire loan book translates into billions in annual revenue. This is why it pays to be an active consumer. By shopping around for the best savings rates, you force banks to compete and narrow that spread, putting more money back in your pocket instead of theirs. Understanding the spread is understanding the fundamental business model of the entire banking industry. Beyond the obvious profits from interest spreads, banks have become masters of generating income through a complex web of fees and charges. Many of these are not immediately obvious and can slowly but surely eat away at your balance. These charges often appear for services you might assume are free or for situations you might not anticipate. For example, many current accounts are advertised as free, but they can come with steep charges if you slip into an unarranged overdraft, even for just a few days. The interest and fees on these overdrafts can be incredibly high, catching many people in a costly trap. Another common area for charges is international transactions. If you use your debit card to make a purchase or withdraw cash while on holiday abroad, you will likely be hit with a non-sterling transaction fee. This is often a percentage of the amount you spent, plus a flat fee on top. These charges can add a significant extra cost to your holiday spending without you even realizing it at the time. Banks also charge for other services like ordering a replacement debit card, receiving paper statements instead of digital ones, or for stopping a check. Each one is a small but profitable revenue stream. Then there are the more subtle fees, particularly those associated with wealth management or investment accounts. These can include annual platform fees, trading commissions, and fund management charges. While these might be presented as small percentages, they can have a significant impact on your long-term investment returns, a process known as fee drag. The bank makes money regardless of whether your investments go up or down, simply for administering the account. It is absolutely vital to read the small print and understand the full fee structure of any financial product you sign up for. Ultimately, financial knowledge is your best defense. Being aware that banks are businesses designed to make a profit is the first and most important step. Always question what you're being sold, read the terms and conditions carefully, and never be afraid to ask for a full breakdown of charges. By being a vigilant and informed customer, you can protect your money from being eroded by 1,000 tiny cuts. Your financial well-being depends on it. Don't just hand your money over. Manage it actively and make the banks work for your business, not the other way around. Follow for more plain truth about money.